Alright, so over the last couple of days, we have seen some pretty chaotic things unfolding in both the tech sector and the banking sector here in the United States. We saw just the recent collapse, literally in just a matter of days, of several high-profile banks. One of them was called Signature Bank, which was disproportionately working in like the crypto space, and the other one was called SVB, which stands for Silicon Valley Bank, that, as CNN points out here, essentially just imploded in on itself in just a matter of about 48 hours. It has since had to, been taken under control of the California government and then the FDIC as well. And so we're going to get into how did this happen, what are the precursors to this in terms of deregulation that we've seen over the last number of years, and how did this happen and what could be done in terms of like an actual response to this, because of course, we're dealing with venture capital here, we're dealing with very wealthy actors in this equation. So of course, in these kinds of situations, the US government is going to run to save them, not exactly how they would usually be in situations to help average working class people. But here to start us off with a CNN article, they say here's how Silicon Valley Bank collapsed in 48 hours. So they say Silicon Valley Bank, the go-to bank for U.S. tech startups facing a sudden bank run and capital crisis, collapsed on Friday morning, leaving its high-powered customers and investors in limbo. It was taken over by federal regulators, and it was the largest failure of a U.S. bank since Washington Mutual in 2008. Okay, so this is pretty historic stuff that we're talking about here, at least in modern history, but they say here's what we know about the bank's downfall. What is SVB? They say founded in 1983, SVB specialized in banking for tech startups. It provided financing for almost half of U.S. venture-backed technology and healthcare companies. Okay, so again, pretty sizable bank that we're talking about here with tens of billions of dollars in deposits coming from, again, disproportionately the tech sector, which obviously has not been doing too well over the last number of months, as a lot of the money, the free-flowing cash as a result of like 0% interest rates that we've had over like the last decade, a lot of that cash started to basically dry up for them, and so you've had a lot of negative consequences there as a result of the recent raising of the interest rates from the Fed, and specifically centering around this sector. And they say, while relatively unknown outside of Silicon Valley, SVB was amongst the top 20 American commercial banks with $209 billion in total assets at the end of last year, according to the FDIC. So they say, why did it fail? The Federal Reserve began aggressively raising interest rates a year ago to tame inflation. Okay, yeah, that's what they were doing this for. Okay, the idea that the Federal Reserve is raising interest rates specifically to tamp down inflation kind of glosses over the fact that we know that an outright majority of inflation has been driven purely by corporate greed to maximize the profit motives or the profit margins of some of the wealthiest corporations in the United States at the expense of American consumers. Okay, we know these facts, right? The idea that this is like some sort of a nuanced tool that they're using here at the Federal Reserve to tamp down inflation, it's completely absurd and ridiculous. And of course, the brunt of the consequences for those actions are going to be felt by people on the bottom rung of the ladder. But they say higher borrowing costs, okay, from these raised interest rates sapped the momentum of tech stocks that had benefited SVB and eroded the value of long-term bonds that SVB and other banks gobbled up during the era of ultra-low, near-zero interest rates. They say SVB's $21 billion bond portfolio was yielding an average of 1.79%. The current 10-year Treasury yield is about 3.9%. And they say at the same time, venture capital began drying up. You also had, startups who were, being forced to draw down funds that were being held at SVB. And so they kind of had this bad mixture here of losing a lot of money on some of those long-term Treasury bonds, which clearly they were like over-leveraged on, and that was taking up way too much of their balance sheet in terms of their assets. And then you have, with this pullback from the tech sector, a lot of people who are trying to cash out some of their money, and they basically just can't keep up with it. And then you have this bank run, and then they're not able to meet the standards, and so the government steps in and takes control. So that's basically what happened, right? You had this massive panic, this massive bank run as a result of basically mismanagement at the highest echelons of this corporation, right? And so of course we've had some calls already immediately from some of the worst neoliberal ghouls within the United States to bail them out entirely. Okay, now there are a couple different proposals in terms of doing bailouts that are specifically centering around depositors, which is what it looks like is actually going to be done. Other people calling for just a complete bailout of the entire company, but we're going to get into a lot of that. First, I want to get into just some of the background in terms of how we got to this point, especially after we all saw what unfolded in the '08 financial crash and how essentially a lot of the banks that torpedoed the US and global economy were rewarded. They were given bailouts. A lot of their executives faced basically no consequences whatsoever in the long term. So, we also passed a bunch of legislation that was supposedly going to fix a lot of those problems that allowed that crash to occur. So what happened in the meantime, right? How was this able to happen with some of those pieces of legislation that were passed that were supposed to be guardrails to prevent this type of situation? Well, we have to touch on this, of course, because under the Trump administration, they decided to cut back or push back on some of the regulations that, had they still been in place, could have potentially mitigated some of the consequences from this SVB collapse. So, as pointed out here by Sahil Kapoor, he says, relevant to the Silicon Valley Bank situation, this 2018 law rolling back parts of Dodd-Frank. It was a GOP-led bill. It sparked a messy fight among Democrats after Senator Warren bashed it as dangerous for consumers, and more than a dozen Senate Democrats disagreed and voted for it, and then Donald Trump signed it. So, of course, this glorious bipartisanship in action in Washington, D.C., where corrupt Republicans get together with corrupt Democrats and decide to pull back on some of these basic pieces of legislation and regulations that could have actually prevented the SVB collapse from happening. Would it have been 100%? No, but you would have had stronger stress tests that were a part of this, and maybe you could have had earlier warning signs that something was not adding up in terms of their assets and their balance sheets, right? But of course, we had Senator Elizabeth Warren, who was, sort of good in this area when it comes to banking regulation, and she was obviously not happy about this. We also had Senator Bernard Sanders at the time, back in 2018, who was also not happy about this and giving us a warning in terms of the exact type of thing that is unfolding right now. So, as pointed out by Jordan here, he says in 2018, Congress, after intense lobbying by the financial sector, pushed to further deregulate the banking industry. Senator Sanders opposed it, citing the CBO, which issued a report finding further deregulation would increase the likelihood of a bank like SVB to fail. Okay, so this was easily predictable. We knew that this was going to happen. Again, this goes for the entirety of the American economy, not just the banking sector. We saw this also just recently with East Palestine and the train derailment, right? This is the consequence of privatization. This is the consequence of deregulation. This is the consequence of allowing the profit motive to rule above all else, right? Where you are not actually, making sure that you are sustainable in the long run, because on top of, there potentially being, all these other tangential consequences within the American economy, at the end of the day, which is exactly what looks to be happening, that the federal government is going to come in and essentially socialize the losses when you put yourself in a horrible position financially, and then you will continue on the back end to be able to privatize the gains. So this is exactly what Bernie Sanders, Elizabeth Warren, other people have been warning about in terms of this deregulation for honestly years now. But a little bit more information in terms of some of the specifics on these lobbying efforts and who exactly was getting funded by who here. So, they say from The Lever in this great breakdown on this entire background of the situation, SVB chief pressed lawmakers to weaken bank risk regulations. Okay, so they say 8 years before the second largest bank failure in American history occurred this week, the bank's president personally pressed Congress to reduce scrutiny of his financial institutions, citing the low risk profile of our activities and business model. How's that working out? Okay, this is according to a federal records reviewed by The Lever. They say 3 years later, after the bank spent more than $500,000 on federal lobbying, lawmakers obliged. Okay, good old-fashioned, legalized bribery and corruption that is on full display within the American political system. This is how it works, guys. This is how the actual sausage is made in the United States. They say in 2015, SVB President Greg Becker submitted a statement to a Senate panel pushing legislatures to exempt more banks, including his own, from new regulations passed in the wake of the '08 financial crisis. Despite warnings from some senators, like Elizabeth Warren and Bernie Sanders, Becker's lobbying effort was ultimately successful because, of course, it was. They say, touting, quote, SVB's deep understanding of the markets it serves, our strong risk management practices. I mean, it's almost like this is a fucking Onion article, right? Becker argued that his banks would soon reach $50 billion in assets, which under the law at the time would trigger enhanced prudential standards, including more stringent regulations, stress tests, and capital requirements for his and other similarly sized medium-sized banks. Okay, so they're basically talking about exactly what ended up being the problem with the collapse of SVB. You don't have adequate stress capabilities, right? You don't have the ability to withstand when a lot of, large depositors are trying to withdraw some of their balances. If you have huge stakes and huge portions of your balance sheet that are invested in long-term treasury bonds, right? That's kind of a fuck up. Maybe you could have figured that out if you had these more stringent stress tests in place at the time, and also the capital requirements. Obviously, they weren't able to meet up with that as well. But they say that Becker insisted that $250 billion of an evaluation was a much more appropriate threshold. Okay, so basically they're playing this game here where they're like, okay, we're trying to push up the threshold for what would be considered a large enough bank in order for these regulations to be applied for it. And they're trying to pretend, as they're approaching upwards of over $50 billion in assets, that like, oh, poor woe is me, like we're not large enough in order to, fall under those standards. It's like, no, you're still a gigantic multi-billion-dollar bank with a huge portion of a huge portion of the American economy that is being funneled through your bank. Obviously you should be meeting some of these more stringent requirements at the bare minimum, but no, he says that's overburdensome, I guess, even though again, as I point out there, could have maybe had some impact in terms of predicting this inevitable collapse of this bank. But they give a little bit more context here, and then we'll finish this article. They say around that time, federal disclosure records show the bank was lobbying lawmakers on financial regulatory reform and the Systemic Risk Designation Improvement Act of 2015, a bill that was the precursor to the legislation ultimately signed by President Trump that then increased that regulatory threshold to $250 billion, exactly what a lot of these banking ghouls wanted them to do. I mean, they're basically just writing legislation on behalf of a lot of these, banking industry people who are funneling money into their campaigns, which they'll get to here in a second, but they say Trump then signed the bill despite a report from Democrats on Congress's Joint Economic Committee warning that under the new law, SVB and other banks of its size would no longer be subject to nearly any enhanced regulations. Okay, so again, the idea that this wasn't, avoidable, or that we couldn't have possibly had regulations in place to try to mitigate the consequences of this type of a collapse. No, that's utter bullshit. Again, this is what happens when you allow neoliberal ghouls to team up with conservatives and try to gut a lot of these regulations under the guise of like, oh, this is going to create jobs or grow the economy. No, it's not. It's going to potentially lead to situations like the one that we are in right now. And then, of course, they point out that there were thousands of dollars that were funneled into a lot of the top senators who were pushing this deregulation. Of course, again, that's how the American political system works in this country. But now again, of course, we also have calls immediately for large-scale bailouts for SVB and some of these other banks as well that have been having issues. Of course, we have Larry Summers, always going to be on the side of corporate America here, saying now is not the time for moral hazard lectures about bailouts. Okay, the reason why this is extra funny is because he's trying to make a moral hazard argument as if like we shouldn't think about the moral hazard of giving bailouts to these massive, VC, venture capitalist centered, tech centered, banks or whatever it may be. He would apply this to probably most of the large banks within the United States, but he's basically trying to say we shouldn't think about the moral hazard of giving these guys bailouts because, they won't learn the lesson that, oh, if the federal government is going to come in and backstop all of our losses when we have an utter collapse due to our mismanagement here, that's not going to have any impact on other banks around the country thinking the same thing. But we'll circle back around to that argument here in a second, because even it looks like some top Biden administration officials are not really thinking about that as an inevitable consequence to this situation. But the reason why it's also funny is because this guy, Larry Summers, was making moral hazard arguments and lectures about things like student loan debt or giving any even crumbs of assistance to average working class families in the United States. He will always bring out the moral hazard argument and say, oh, if you give these students this student debt relief, even the modicum of student debt relief that Joe Biden has been pushing forward with like $10,000, $20,000 for Pell Grant recipients, he was trying to say that, oh, that's going to lead to a moral hazard. People won't be as incentivized to enter the workforce, and you're giving out all of these handouts that are going to make people lazy and have all of these other tangential effects. But somehow, none of those arguments apply when it comes to these wealthy billion-dollar Silicon Valley banks. I mean, it's just amazing at this point. Now, we have the Biden administration's take on this, which is basically doing a bailout, but trying to pretend as if it's not a bailout and using semantics to justify that, but I'll explain why that seems to be utter bullshit here in a second. They say from the Hill, Biden stresses that Silicon Valley Bank is not getting a bailout. They say President Biden on Monday stressed that the SVB will not get a government bailout after regulators seized the assets of the failed bank, saying, quote, no losses will be, and this is important for point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund, also known as the DIF, Biden said in remarks at the White House. And Treasury Secretary Janet Yellen on Sunday also says that she's ruled out the possibility of a bailout for the bank's owners and investors, saying that in the aftermath of the 2008 banking crisis that we're not going to do that again. Okay, so this makes it slightly better if you're not going to be bailing out the bank's owners and investors, but also you have the issue that a lot of these, owners and executives within this company apparently cashed out millions of dollars while some of their employees were getting bonuses. Some of these bonuses were coming in literally hours before the FDIC went in and took control of this business. Okay, so a lot of them have already cashed out at this point. So, the idea that they're not going to be totally fine after pulling off this scam here. So they're already going to be fine. Some of the investors will probably be hurt, but that's totally fine. Biden said that's how the capitalist system works. You made a bad investment, you have to reap the punishments for that. So that's a little bit better of a bailout. But the idea that this is not going to be something that affects taxpayers is also kind of nonsense, because if you're backstopping this SVB bank and Signature Bank, that other one, right? If you're backstopping that and you're basically saying we are going to cover all of the deposits that have been lost at this point, right? We're going to do that immediately, step in over the weekend, do it in just a matter of days, then what you're effectively saying is even if you have losses for a lot of these people who are at these banks that are above the current FDIC insurance threshold, which is $250,000 that is supposed to be guaranteed, as part of the FDIC insurance program, even if you have, multiple times more than that, or millions or tens of millions of dollars stashed within these banks, or billions of dollars, the federal government is going to backstop that. And so that does send the message across the American economy to other banks that yes, we're just basically completely disregarding the actual rules and procedure that would typically be used in a situation like this through the FDIC, program that they have, and we're basically just going to ignore that and backstop all of that. And so Jeff Stein asked a good question about this directly to Janet Yellen. So he says, I asked Treasury this question on a call with reporters this evening. This was their response. So he says, isn't that exposing U.S. taxpayers not just to the uninsured deposits that need to be guaranteed in this instance, but for trillions more throughout banks in the country? Okay, and she says, I think we will. Right now, we are very focused on addressing the current issue and taking of the current system and stabilizing the banking system and assuring uninsured depositors that they will be made whole. But I do think we will be looking back with time and reassess and assess whether any changes should be made. But I just want to emphasize again that the DIF, that insurance, is funded by fees on the banks. They will refill it with fees on the banks if they use it. It is designed to protect depositors. Okay, so she's saying basically we're just acting in the short term. We're trying to save this bank. Who knows what type of message that will send to other banks around the country, where again, you're basically just guaranteeing we will give your depositors a get out of jail free card, if you engage in some sort of mismanagement at the top levels within your company. I mean, again, obviously that's going to have, reverberating effects around the American economy. You are basically guaranteeing that the federal government, the Treasury, is going to step in and back up all of these deposits, regardless of the usual $250,000 cap. You're going to backstop all of them. At least that's the message here, unless you're making some sort of a specific exemption with this one SVB bank and Signature Bank as well that wouldn't somehow apply to any other context. But on top of that, she's trying to make the argument that because this deposit insurance is funded mostly by the banks, or the fees that are put on banks, right, to go into this pool of money, right, for this type of a situation. Well, where do you think those banks are going to pass on the costs associated with that, right? If you have to raise the fees on some of these banks to recoup some of these losses that you're now incurring, who do you think they're going to pass that on to? They're not just going to cut into their own profit margins. They're going to pass that on to consumers like you and me who use other banks, right? That's how that's going to work. So either way you want to put it, yes, it is a bailout, and yes, it is going to affect average working class Americans, regardless of how you want to try to get around that. Now, that's basically my analysis on this. Listen, I understand some people saying that like, oh, well, you had to, backstop these depositors. We also had a lot of people like Charlie Kirk who were, of course, blaming this on wokeism. Don Jr. said this as well. But, this is just kind of like a funny way to end this video, I guess. It's a mystery why Silicon Valley Bank collapsed. And he's just pointing to like diversity, equity, and inclusion as if that had anything to do with this equation. But again, back to the point. My main takeaway from this is that there are a lot of people who are saying, yes, of course, you have to immediately backstop all of these deposits. You have to save this bank, right? Even if you have to liquidate some of their assets in order to do it. Okay, now I understand that argument because you're saying, oh, well, we don't want this to spread. We don't want there to be contagion across the, entirety of the American economy. So we have no choice. But there are other people who are making the argument, which I happen to think is the better argument in this equation, where basically they're saying that, you could have had this bank collapse, right? And instead of having the federal government step in to backstop all of these deposits, you could have just shaved off like 10% off the top of what a lot of these, depositors were, actually going to get back at the end of the day, right? Which is not that much. Like 10% is, you're still getting back a large swath of the money that you would have had. And you wouldn't have had to have this massive intrusion from the federal government. So I think there's a lot of, interesting debate going on in terms of like what could actually, be the correct solution in this circumstance. But listen, my takeaway from this is that look at the difference between how they react when some giant Silicon Valley, venture capitalist tech startup bank falls off the edge of a cliff because of mismanagement at the upper echelon within the company versus how they respond to something like the Norfolk train disaster or Flint, Michigan, or any number of other instances, the Mississippi water crisis, right? When you have millions of Americans who are living in poverty, who are working class people, who are desperately in need of help, oh, suddenly the federal government has no money, we have no way to possibly address this, we can't give material support too much to these people or else that will create some sort of a moral hazard. But then when it happens to a large multi-billion-dollar bank like this, everybody immediately is jumping to a massive, widespread, multi-hundred-billion-dollar bailout, and then also proposing, I guess maybe we backstop the entirety of the banking sector. I mean, again, it's like nobody learned anything from '08. And honestly, again, this is just a perfect case study example of a lot of these corporations in the banking sector who are basically just privatizing the gains. And then when times get tough like this, socializing the losses onto the rest of us. So if you're going to have that mentality of it, well, then at least nationalize the banks, right? At least bring them under public control, right? And have that be your approach if you're going to be socializing the losses, or else this is just a even worse, doubled up crony scam that we are going to continue to have to pay for every single time that some ghouls on Wall Street or some, random banking executives decide to have a terrible management strategy.
Everyone is saying good Politic guy has the best politics. Believe me, no one does it like him. Believe me, everyone is saying